Welcome to this conversation on Business Redefined. We want to talk about matters central bank digital currencies. The CBK issued a discussion paper not too far back, and we are privileged to have the man in charge, that's the Governor, Dr. Patrick Njoroge. Welcome on set, sir.
Thank you, Julian.
Such a privilege to have you. Let's kick this off. CBDC within the context of financial inclusion. In Kenya, if you look at the latest report from the Free Access Survey, formal financial inclusion up 83%. Those totally excluded down 11%. And the question is, how does the conversation of a CBDC now come within the context of financial inclusion?
Thank you, Julian. It's great to have this conversation with you. The issue with CBDCs is that there are many reasons, potential reasons for issuing central bank digital currencies. Some of the central banks or jurisdictions that we are in touch with have actually pushed the idea that they would want to issue central bank digital currencies so as to improve the level of financial inclusion. And they have explained it one way or the other. Most of them would generally have low financial inclusion, meaning 50% or below. Or others would be, maybe there is some improvement, maybe a lot of them are included, but the processes are very difficult. So they want to have some sort of anytime, any place sort of transactions, and hence perhaps the CBDCs would facilitate that. Now, for us in Kenya, as you mentioned, our financial inclusion level was estimated recently as something like 85%. And that is up from 27% back in 2006, 2007. So we've done we've made substantial inroads into financial inclusion. The question then is the remainder, the 11%, as you asked, how are we going to bring them in through CBDCs? That's precisely why we have issued that discussion paper, so that we can understand better how this sort of considerations would play out. From our perspective, it's not sort of a foregone conclusion that we will or we will not have the CBDCs there. That question needs to be asked and actually explain how the financial inclusion will be improved in this way. But again, financial inclusion isn't everything, meaning there are other reasons one could have, and we have elaborated some of them in thumbnail sort of sketch in the paper, hoping to hear from the population their views and then sort of weigh all the items and make a decision in the future.
All right. Governor, in a market where we have proliferation of mobile wallets, and as recently as 2 days ago, the main player in this market indicated it has hit 30 million monthly active users. The question the telcos are asking is, and Kenyans generally, what does this mean in a market where already we have such penetration of mobile wallets?
I think the point is that first we have to accept that and pay tribute to those that have worked to build a rather elaborate ecosystem. And the ecosystem has actually been very useful for the population and indeed for all of us in supporting the transactions that we are there. That point should always be accepted and flagged. However, we cannot remain where we are. We have to move forward. Our aspirations are quite high where we want to go. So, for instance, one of the points that we've made out there is that we need to improve, for instance, the issue of cost. Right? That is not a foregone conclusion that the current cost structure is actually appropriate. Efficiency, right? Speed, security. All those are considerations that are important, including also the issue of consumer protection. So the current ecosystem works, but it needs to be improved. Maybe having a CBDC, a central bank digital currency, could help in this journey. And that is why we are asking that question. At the end of the day, the journey is to improve the payments sort of ecosystem. And we can discuss it later, we actually recently issued a national payment strategy that actually addresses some of those things. But I think the point here is that the the central bank digital currency should not be seen as sort of in competition to all these other elements, or should we say other ecosystems that are there, or the products that are there. It should be supportive. Now, on the other hand, that's not a foregone conclusion that it will be. So I think that's why we need that discussion. And if the PSPs, or should we say the payment service providers, have opinions or viewpoints, certainly we also welcome their views, and we'll take them into consideration.
I hear you. Another big issue around this conversation is the potential disintermediation of the banking sector. Because the question looming large is, if the central bank gives us such a credible, secure platform, why would I be having a bank account? Where do we leave banks in this conversation?
Okay, that's a good question. And I think maybe before answering the question, I need to explain a little bit what, in a thumbnail sort of way, what CBDC is, central bank digital currency. The idea is that the central bank, today and now the central bank issues paper currency. Yeah, it issues paper currency, which you carry in your pocket and you use it for transactions, etc. You know, just like you may have a bank account, the central bank could, in theory, not just the Central Bank of Kenya, but any central bank could, in theory, open an account for every single member of the population. And so it would appear like, let's say, your current account, the way you run your bank current account, but it would be an account that is resident in the central bank. And so you can make your transactions, etc., supported by whatever other infrastructure and ecosystem that is out there in terms of the payments ecosystem. So it is true, if the central bank issued such an account to every single individual, then that would be in competition to, let's say, the banking sector, right? And secondly, there is the consideration that if indeed it is in competition with the banking sector, why would I, as a citizen, leave my money in a bank? I mean, I want it to be safe, so most likely I'll put it, even if there's zero return, I'll probably put it in the central bank. So there is that consideration. So technically, there may be some disintermediation, and that's really the question you're asking. Now, it has to be seen against the benefits that may be coming, right, from CBDC. So, and this is why, again, we need to emphasize that we need to understand where we are in terms of weighing the pros and cons, the benefits and the costs. So there is a clear cost or potential for disintermediation. But then there is all the benefits. We talked about potentially improvement in financial inclusion. Now, for us in Kenya, that may not be the biggest selling point for the reasons that I mentioned. But there are other things, and one of the points that we have talked about is it may facilitate lowering the cost of cross-border transactions. And now, is that something that is clear, in a sense, the design is clear to provide that product? I mean, to make sure that the cross-border transactions work? The answer is no. Things are still in the very initial stages. As you know, I've been involved in some of these international fora where those discussions are taking place, and indeed those tests are taking place. And I think the point for us is we want to, whatever we do, we want to do it with an open mind, and we want to be properly advised. We know where the benefits could potentially be, but at the same time, we need to weigh this. Bottom line, in any event, is if it is a currency that the population are holding, the population have to accept the currency. You cannot force a currency on a population. And so it is important, even from that score, just to get the viewpoints of the population.
I like that. So, Governor, maybe let me just push that a little further. Globally, we know there are almost about two models of going the CBDC route. So you could have the unilateral, where the CBK basically hands everything, including to the retail level, or there's a hybrid where now you work with other payment service providers, banks, etc. Do you have a sense as to where we could be leaning as a country?
At this moment, no. I think the point is everything is on the table. the designs of this. Unfortunately, the conversation in this sort of space has been too much in the space of technology. The point here is that we don't want to be caught up in the technology conversation because we believe whatever we do, we can do, the technology we can fix. That's not the issue. So the issue is, why are we doing these things, right? Why is it that we are having the CBDCs? And the models that we have, there could be many. The one I described is very much one unilateral central bank that is working on. This is the retail CBDC scheme. But you could have others where, let's say, you have others, let's say, banks, or for that matter, telcos or other institutions that actually provide the second leg. So you don't have every single person having an account in the central bank, right? So I think the point here is that at this moment, we are agnostic as to what the model is. We want to first identify what the benefits are, what the costs are, and then we can weigh this and see which model does what best. But again, we need views from everybody.
Okay. One of the key selling points of CBDCs is resilience in the payment system. And within our context, if I could give an example, if you look at our payments ecosystem and the role that mobile money plays, if the dominant player suffers outage, for instance, it's normally chaos in the economy. How do you see then the CBDC playing within that context?
Yeah, I think that is not quite correct. CBDCs are as vulnerable as any other piece of technology. And here we have two recent examples. As you know, there are a few countries that have started off on their CBDCs experiments. Close to us, you have Nigeria. You have the first one was actually Bahamas, which issued the Sandora, and you had the East Caribbean Central Bank that issued their Dcash. You have others as well, but the point is there are two of those that actually hit some significant outage. Just like ourselves here, occasionally one of the, let's say, payment service providers has an outage. So I think the point here is CBDCs are as weak as, let's say, the technology that they ride or the design that they have. The point, it's not something that you can say for sure that it is immune to all those potential vulnerabilities. So the design and the implementation of it has to be cognizant of those things. Now, one can argue that it offers a sort of a second leg or a second layer of payments possibilities. And I think the point here is that is one of the arguments that has been put forward for CBDCs, that to improve the payment system, the payment processes, etc. Again, it's not a foregone conclusion that actually that happens. The fact that we have these CBDCs does not mean that they are immune to the vulnerabilities of any technology, etc. So I think the point here is, let's design them, but let's understand what the vulnerabilities are and design them appropriately.
One of the questions that central banks are asking around this issue of intermediation is, should CBDCs be interest-bearing or not? And why that question is important is because what would this mean for banks which rely on deposits if majority of us then feel I have safer and better returns with the central bank?
Again, the design of it in terms of the resources deposits that are held in the framework of the central bank digital currencies, will that be digital currency, would that be interest bearing, etc., or not? Those sort of details have yet to be thought out. All I can say is today and now, what you hold in your pocket as central bank liability is not interest bearing. So it is just flat, it earns nothing. But there are other things that are important, and I think it is important to flag them. First is obviously the issue of anonymity, right? So the central bank knows exactly who is holding what currency in this context, right? Or holding which specific, you may call it which note, e-note. So they know that it is Julian who is holding this e-note, and then he transacts it to me, and now it's me who is holding it. So the issue of anonymity very much falls by the wayside, which is not the case for your liability, the paper cash, etc. So that is important to appreciate. Obviously, there's the issue of speed, right? And that one, obviously, the transaction is working at the speed of light, right? You make the transaction, it happens today, as opposed to, so you can do an anytime, anywhere transaction. So those are all potential benefits. But remember, that may not be where the largest constraint is in the payment system, in terms of security, in terms of speed, in terms of cost. So I think this is why we need to be sure that even when we ask about, let's say, an item or an aspect like interest, is it interest bearing or not? There's this whole other wide set of issues that need to be put on the table. There's something I said earlier that I want to come back to, which is the issue of whether CBDCs will actually improve on our payment system. It's not a foregone conclusion. Those that have been pushing, let's say, so-called coins, stable coins, and all those other coins that are out there, have been making the point that have been pushing them under the sort of flag of it will improve the payment system. That's not a foregone conclusion. It's amazing how at times we get onto a bandwagon and you ask for the proof and there's no proof. So from our perspective, it costs something, particularly for us that have a very elaborate payment system. I think the question is the 11% that are still, or 17% that are still outside the financial system, how do we bring them in? And the question is, why is it that they're still out there? And their concerns are actually, from my perspective, are not going to be picked up so easily by the CBDCs. The reason you have those people out there are things, for instance, relating to, let's say they don't have ID cards, or they are young and they have just not moved up to the point where they can get a phone by themselves, etc. Or some cultural issues, yeah. So particularly for women in some, let's say in some villages, women are not that free with phones, etc., etc. So we cannot deal with that with CBDCs. So let's figure out what problem we are solving and then deal with it.
I like what you brought, Governor. One of the hopes around CBDC, especially in the Kenyan context, is because even within the COVID context, the sweet spot has been the diaspora remittances. They've been so resilient. And the hope is that if we have a cost reduction through the CBDC platform, then we could even have more resilient, more robust remittances. Do you share this view?
I share the view that it is important to reduce the cost of cross-border transactions. By the way, you should know that we did a diaspora survey recently, which we issued, I believe, in December. There are details there about the cost of transaction, which are still way above the 3% target that we have, indeed, as a people, as a community, intend to have in the context of the SDGs, the Sustainable Development Goals. So the idea is to bring down the cost of transfers to less than 3% by 2030. We are still far away from that. But at the same time, there are other means of bringing down the cost of transaction. And this is really one of the things that we have picked up on. And we have raised it in the context of our national payments strategy. I would encourage you and others to read the national payment strategy. It is the first time that we have put together. It is true we had an earlier strategy something like 10 years ago, but I think this is the first one that we have actually gone around the world and benchmarked it against the best out there. And when we launched it, we had contributions from various, let's say, peers, you know, the BIS, the Alliance for Financial Inclusion, etc., and other central banks around the world. and in our region, all of them sort of pointing to the quality of the product and what we've done there. The bottom line is we need to reduce the cost of transactions cross-border and indeed also internally. And there's a lot of work we need to do there. And it may be beneficial from the perspective of having a CBDC in this regard, but I think we have a lot of other things that we need to do in order to bring down the cost of those transactions.
I should say, for the sake of our viewers, BIS is Bank of International Services.
Yeah, that is correct. That's correct. Julian, thank you.
So, Governor, the question out here also lies in the fact that what would a CBDC mean for the central bank from a cost of cash standpoint? And why that's important is because every time we look at your annual report, of course, there's the bank inventory and the printing and minting of coins. What would this mean for the bank?
Okay, so there is an argument to be made that if we actually switched to CBDCs, the cost of minting e-currency, e-shillings, would be lower than the cost of minting the paper currency. That may or may not be the case, by the way, and I'll explain why. I think at first blush, you could say, yes, it is. So you lower the cost of minting, etc. But you know, the cost of technology is not zero. One of the things that I think a lot of us don't quite see, any platform to actually build it and maintain it costs some serious money. And that, in some sense, is once you start, you have to maintain it. The maintenance cost, for instance, ensuring that very simply, all the cyber security protection are in place, maintaining it 24/7. So I'm just making the point here that let's not be too quick to saying that just because you can mint the marginal cost of minting an e-shilling is virtually zero, therefore the total cost is zero. That, I think, is not so clear. And frankly, for small economies, it'll be harder to make that argument. So for a large economy, I think the costs, the average cost will be low. But I think for a smaller economy, the average cost will actually be relatively high. So that also has to be examined. But it is important to remind people that the marginal cost of these things is not what we should be looking at. There is a certain cost of just maintaining that, you know. So I think that's. Now, the other costs that one considers, but I think these are things that one can consider at the same time as the other benefits that one sees.
And again, for our viewers, when the governor talks about marginal cost, it means the additional cost incurred for a unit production.
Thank you. Thank you, Julian.
Let us move on with this, Governor. Many are concerned that we have a digital divide out there. And here we're talking about a digital currency.
Yeah.
How do we intend to bridge that and ensure everyone now is looked to?
That's an excellent question, Julian. The point is that actually, there is an argument to be made that such a development could lead to greater financial exclusion. So some people will fall out of the financial system just because we have moved to this thing. And let me give you a simple example, which probably, with some details, but think what would happen if, say, a telco operator decides, we are going to go into 4G. The minimum we are going to have today is 4G. So all of you that are on 2G, you either invest and move up to 4G, 4 or 5G, or we are done. We are turning off your system. That would be terrible. Why? Because more than 50% of our phones are actually feature phones, meaning they are 2G, etc. So that is what would happen if that could potentially happen if we actually pushed on this and forgot all the other people in terms of who may not be coming up to the CBDC level. Mind you, the CBDC will have a minimum technology requirement, minimum viable technology requirement, right? And it may be a sort of a 4G environment. So in effect, you're actually pushing away people that are not in that space. That is something we need to be careful about. And it is important to appreciate that every person out there, every Kenyan, we should be thinking about their welfare. It's our business to worry about their welfare and to provide a safe, secure, and fast infrastructure that will provide benefits to that person. So I really think it is important to worry about the point you've raised. We don't want to create that divide or widen the gap. On the contrary, we want to close the gap. And so we may decide, therefore, maybe we should wait a little more until other technology catches up. I mean, because at this moment, the 2Gs and I guess the 3G as well, but anyway, the lower level technology are quite prevalent with us. So I think we need to look at all these things together. So, I mean, put everything on the table, but that is exactly a big concern for us as a central bank.
I see. Let me go back to the point you raised about anonymity. And when you talk about CBDC and the anti-money laundering fight by regulators such as yourself, to what extent do you think this will push the envelope further?
Okay, maybe we should say a few things before that. The issue of anti-money laundering is that we do not want to support transactions that are illicit. So the financial transaction, on the other hand, on the other side, they support a sort of actual transaction of products, services, etc. So from our point of view, our financial system should not be used for those illicit, illegal transactions. That is the basic thing. So we put in place measures to ensure that those that are engaged in those transactions do not find it hard. So we want to control that so that they will find it impossible, right, to make their transaction. So that's the sort of argument behind it. Now, CBDCs, the expectation is because it's the central bank, you will maintain, or the central bank is the one that underpins these transactions, that is of a central bank digital currency. It will have on it, layered on it, sufficient measures to ensure that those transactions, illicit transactions, don't take place. So that is the argument. Now, it also means that if we actually put it in place, we have to maintain that engine, if you may, and ensure that it's always learning, because as you can imagine, those that are involved in these illicit transactions are always changing the way they operate. So it isn't sort of a, just one shot. You have to maintain it all the time, 24/7, etc. Bottom line is to have a proper, safe financial framework or financial system. We do need to make sure that those other illicit transactions that are involved in money laundering or other items, whatever it is, people trafficking, drugs, etc., corruption, as much as possible, are kept out of the system.
CBDC as an agent of facilitating monetary policy transmission. Any comment on that?
Again, this is something that we have talked about, or needs to be thought through. At the end of the day, it's not only about financial transactions. That is sort of one of the reasons for having money, facilitating transactions, etc. But from our perspective as central bank, we also want to, let's say, produce certain outcomes in the economy. So for instance, We want to stimulate the economy a little more because, let's say, the economy is showing, going into a dip, let's say. So we may want to improve or loosen monetary policy. So that is really, or if things are really getting out of hand in terms of, let's say, inflation, etc., we may want to tighten monetary policy so as to cool down the economy, etc. That is the role of monetary policy. And it is a key driver in terms of outcomes or balanced outcomes in an economy. And I think so far we've done pretty well in achieving some of those outcomes. So the question is, if you end up having a CBDC, central bank digital currency, will that weaken the transmission of monetary policy? And the question is, the jury is still out on that. But the point is that you mentioned that you may end up disintermediating and pushing commercial banks out of the money system, as it were. And as you know, central banks are a key element in the transmission mechanism. So the point here is that it is not a foregone conclusion that you may end up weakening your monetary policy. Now, I agree that it is not the only way of weakening your transmission. I mean, for instance, think of when you have a particular exchange rate policy. That also has, between, let's say, a flexible exchange rate policy and a peg, I mean, the economists will tell you that those two are not, the effectiveness of monetary policy in those two environments, depending on whether you have a small open economy, etc., are not the same. So I think the point here is that we need to think through that. But we as, let's say, the ones responsible for monetary policy, definitely do not want to give up. And having seen how quickly or how effective we can be on monetary policy, think about what happened during the COVID-19 pandemic and the policies that we put in place, which were actually the first policies that ended up improving or let's say, protecting the economy from further sort of decline. I don't think at this moment we would want to say that, well, yeah, take away monetary policy and we'll live happy ever after. So that's why we need to look at all this. But we definitely want to hear from the population, and they should send the messages directly, not necessarily write treatises in newspapers and other places. Let them write to us as well. Yeah.
My final question, Governor, I'll be remiss if I don't ask you this. The risk environment seems to be evolving. It looks like COVID-19 is receding to the back burner. Ukraine and Russia, who would have thought would be where we are today. How do you see yourself? And I know you might be in a closed period with the MPC just coming. How do you see yourself recalibrating monetary policy?
That's a difficult question. Well, not so much difficult. It is, if we have 10 hours, we could discuss that, right? Maybe to put it a little different, you are right, the balance of risks have changed very quickly. Who would have thought that we'll be in a space where we have a war going on in Europe, no less. We have almost on the brink of a nuclear sort of war. We still have significant problems on the COVID-19. It's not fully behind us. And the price of oil is, today I checked it, it was $111, dollars per barrel. I mean, just a few weeks ago, we were talking $70 a barrel, and we were thinking 80 would be exceptionally high. And now we are looking to 80 and saying, please, let's go back to 80. The point is, this is really why we are in the business that we are in. Meaning those shocks come, and we have to deal with them. We don't want to shrink from them. We have to address them head on. The point, of course, is these are tsunamis, right? And we have to deal with them based on the tools that we have. So I don't want to just discuss monetary policy as the end all and be all for policy. Of course, there are other things that are there. And I would actually say one of the policies that have been there is on the fiscal side. For instance, the reason that the price of oil, the price of at the pump, has not gone up as much as, let's say, the price of crude oil has, is because there has been a specific policy to cushion consumers from that very surge, hoping that the prices will come back down again, because the ultimate solution is not, Kenya is sort of collateral damage, right? So the ultimate solution is for the the large advanced economies, the G7s, to sort of weigh in with the other oil producers to increase the volume and thereby bring down prices and lower sentiments, lower the risk sentiments, etc. So that's really our business. But I think the point is, these are hard times, and I think it is important to appreciate that if it is tough for the policymakers, it's very tough for families. It's very tough for the common. It's tough for the common person on the street. So when we see people struggling, I think we should pat them on the back. We should say, you've come all this way. We still have a few more kilometers to go. It's a marathon, but let's do it together. Let's continue.
All right. Dr. Patrick Njoroge, thank you so much for your time. We really appreciate it.
Thank you, Julians. I appreciated your conversation.
Thank you.